Hello and a very warm welcome to Political Economy with Shweta Punj. Well, we are living through very uncertain times. They can be best described as very complicated with a whole lot of uncertainty. There are tariff wars and uprisings and geopolitical conflicts reshaping the world. Multilateralism has taken over and AI is possibly the biggest disruptor which countries and economies around the world are grappling with. To understand the future of trade tariffs, the changed global economic order, the global growth risks, and what must India do to broaden its engines of growth, I have with me today Mr. Jahangir Aziz, someone who has analyzed emerging markets for over 4 decades. He's the head of emerging markets at JP Morgan, and he's joining us from New York. Mr. Aziz, thank you so much for joining us. Delighted to have you here with us on Money Control. And you are joining us from a country that is really making headlines every single day. Every night when I go off to sleep, I wonder and I think about what will I have to wake up and work on the next day because Mr. Trump would have made some 5 statements. So, how are you looking at this evolving situation in the United States, Mr. Aziz? We are waiting for a Supreme Court judgment on the tariffs. What's the kind of impact that you see on on global trade in case the tariffs are considered to be illegal by the US?
So look, we've been tracking the IEEPA court hearings for a very long time, since I think May when it all surfaced. And if you look at the original Court of International Trade's judgment, that ruled IEEPA illegal for two reasons. First is that in IEEPA itself, there is no mention of tariffs as a instrument of policy reaction. It is embargo. Now, IEEPA was created such that in the case you have a very unprecedented event, right? Let's say a country takes US citizens as hostages, something extreme like that. There's no way in which you can respond to by tariffs, etc. So the idea was that then the president is allowed to have complete trade embargo. So the term used in IEEPA is embargo. So the president can embargo against any country. In the event you get these extreme emergency-like events. The problem with what this White House has done is that you can't cite a trade deficit of 3.5–4% as an emergency because it's been happening for the last 20 years.
Absolutely. Right.
Number two is that outside of IEEPA, there are at least 4 different trade acts which specifies what the president can or can't do with guardrails, restrictions on tariffs. So the argument by CIT, the Court of International Trade, is that if the Congress intended to allow the president to have any power, unlimited power on tariffs, then they wouldn't have separately put out restrictions on the powers of the president on tariffs in 4 or 5 different trade acts. So, therefore, the Congress never intended for the president to have unlimited power, unless it's an emergency situation. But in that case, you can use trade embargo, but you can't use tariffs. Now, that went to the Federal Appeals Court, and the Federal Appeals Court upheld the CIT's decision and is now with the Supreme Court. If you look at the hearing of November 4th or 5th, when the hearing was done, similar questions were raised by the Supreme Court justices in their questioning. In addition, the Chief Justice, Roberts, his question was much more linked to what is called a major question doctrine.
Okay.
So this Supreme Court, the Roberts Supreme Court, in the past have made the argument that if a question is of major consequences, then it has to go back to the Congress. The president can't rule on it. And they made that decision on two occasions, one on immigration, and one when President Biden wanted to waive the student loans. The student loans waiver was blocked by the Supreme Court, saying that's a major question, and therefore, by the major question doctrine, it needs to go back to the Congress. So while the other Supreme Court justices in various ways were questioning the validity of IEEPA, the Chief Justice wasn't. He was questioning that if this has major consequences. If it has major consequences, then by the same principles in which we have ruled in two other cases, you can go back to the Congress. So the chances are that even if we don't have a ruling, IEEPA will most likely, and that's what most legal experts say, that IEEPA most likely will be made, it will be invalid in this case. Now, what happens after that? So if IEEPA is made invalid because none of the trade deals have been passed by the Congress, they are not trade agreements. If they are not trade agreements, then the basis on which you've made the trade deals falls through. Therefore, the trade deals will have to be redone. Now, the Supreme Court can't say that, look, IEEPA is invalid. IEEPA was used to make the trade deals, but the trade deals are valid. Okay? They can't say that. If they had been actually passed by the Congress or by the legislature in the countries with whom the deals were being done, let's say Japan or Korea or European Union, then it would be a trade agreement. If it's a trade agreement, you're fine. That's an agreement between two countries, but none of the trade deals are trade agreements. They're just trade deals signed between two governments that have not been validated by either country's legislature or parliament. And if that is not consent or trade agreement. So the first thing that happens is that all the trade deals necessarily become invalid. The second thing that happens, which is the other thing that the Court of International Trade said, was basically that because IEEPA is not the right way of imposing these tariffs, all the tariffs collected will have to be reimbursed.
Oh, okay.
So there is roughly, we are looking at about, our calculations, about $165, $170 billion of tariffs that have been collected under IEEPA. Remember, there were tariffs that are being collected that is not under IEEPA, which is under Section 232, which is these tariffs on steel and aluminum, which are these 50% tariffs, autos, 25% tariff that is imposed, which is outside of IEEPA. Then there are tariffs under Section 301 that have been imposed on China since 2019. Those are not under IEEPA. The IEEPA tariffs are the tariffs that have happened over the last few months, right? And the trade deal tariffs, the reciprocal tariffs, which is how they describe it. All the taxes, all the tariffs collected, which is, as I said, $165, $170 billion, and probably in the last 1 month, we don't know how much that's gone up by. Maybe it's $180 billion now. All of them have to be reimbursed. The Department of Justice has actually had informed the Court of International Trade, saying that this happened about in the middle of December, saying that in the event that the Supreme Court does make IEEPA illegal, we will abide by your judgment that the tariffs will have to be reimbursed. However, we will only reimburse the tariffs only to those companies that have actually filed a case against IEEPA.
Okay.
So guess what has happened over the last. So the original case was done by about 5 small businesses.
Okay.
Guess what's happened over the last 1 month? About a few thousand court cases have now been filed against IEEPA, including very, very large retailers like Costco and others, right? So I think that, you have a situation where the first event is that the trade deal is no longer valid. Second, they will have to pay back maybe not all of the $180 billion if the Supreme Court rules that, only those who have filed a case will have to be returned, but a substantial chunk of that will have to be returned. The problem with all of this is not that the equity market will have a problem, it's a bond market that will have a problem. Because the bond market right now is still looking at the fiscal deficit for this year, 2025, and fiscal deficit for next year, 2026, based on roughly around 250-300 billion of additional tariff revenue. That is not part of the budget that was passed, the one big beautiful bill. The tariffs were not part. So they look at the budget deficit of the one big beautiful bill, and they're adding the $250 billion to it, which is the tariff revenue. Take out the tariff revenue. Then the second thing that happens is the bond market says, well, the fiscal deficit is now 170, 180, $200 billion more, both for 2025 and 2026. So suddenly, the very calm, benign, and very controlled bond market will necessarily react. Now, against that argument, since you asked the question again, I know that's a long answer, is that what happens in the next steps? Well, the next steps is that they go back to the several other trade acts that allow the president to go and impose tariffs. The first thing we think is called Section 122. Section 122 allows the president to impose a 15% tariff for 150 days.
Okay.
But there are problems with it. The problem is you can give exemptions to categories. So you can say that the 15% tariff will not be imposed on semiconductors, not be imposed on electronics, not be imposed on energy, not be imposed on food, but you cannot say, well, within food, we will give exemption to these 7 countries and not to the others. You cannot do that. You can either give exemptions for the entire broad category, or you cannot. So you cannot do what they have done on autos. There's a 25% tariff on auto, but there are countries that are exempt from it. Japan has a low tariff, Korea has a low tariff, Canada and Mexico, because of the free trade agreement, doesn't have any auto tariffs. The other problem with Section 122 is that it says, because you have a free trade agreement, that cannot be an exception. You cannot say that I have a problem with my balance of payments. And there are these countries who are running these massive trade surpluses with the US, which is why we have a balance of payments problem, which is why we're imposing a 15% tariff for 150 days. But we are exempting the 2 largest countries that run trade surplus with the US, which happens to be Canada and Mexico.
Absolutely. Right.
But that's where the problem is. If Canada and Mexico now becomes part of the 15% tariff, then there is a serious hit to US supply chain and US inflation. The reason why US inflation has been benign is because Mexico and Canada, the entire supply chain over there, has been exempt from the reciprocal tariffs.
Right. Okay.
The normal way of doing this tariffs is to use what is called Section 301 and Section 232. 232 you've already seen, which is these sectoral tariffs. Section 301 tariffs can be imposed on specific countries. It was imposed on China. The issue with Section 301 is that the tariffs have to be calibrated for every item. When Lighthizer, who was at that point in time US trade representative, imposed the tariffs on China, the document was about 400 pages.
Wow. Yeah, because
furniture made of engineered wood is different from furniture made of natural wood. Each of them you have to justify as to why you're imposing the tariff. You can't just blanket say everything, I'm going to tariff at 25%. You
Which is
can't do
what
that.
Mr. Trump has been doing. Yeah.
That's the easy way out,
Yeah.
right? So yes, there are ways out for the US.
Right.
Doesn't mean that tariffs will go down. Tariffs will probably be able to go back to the same level as we have right now, but
Okay.
there'll be very different tariffs, which will affect different countries differently. On top of that, it will affect different items differently. And the impact of these tariffs on US revenue, tax revenue, tariff revenue will
Yeah.
be very different.
So,
So that's the
so,
point.
so, Mr. Aziz, if I were to understand this,
Yeah.
how do we see India, India's position in this whole scenario? Because this trade deal with the US is a big overhang on India. We've been going hot and cold for the past 6 months. It's driven our equity markets into a
Yep.
tizzy. Right? It's really, and it's hurting a lot of small exporters,
Yes.
medium-sized and small businesses
Yes.
are hurting. Government has also been in a wait and watch mode because they don't know whether they should go ahead and extend financial assistance or not. So it's led to a lot of uncertainty. How do you see India placed in this scenario? And in your view, what should India really do to be able to to be able to tide over this uncertainty? And how do we make our how do we get stability in our trade policy when it comes to dealing with the US?
Right. So one of the things that what will happen if IEPA is made illegal, IEPA by itself, right, was the basis of the 50% tariff, right?
Right.
Uh, I mean, there is no trade act in the US that allows the president to impose tariffs on a country because the tariffs bought oil from Russia. There isn't any. The tariffs can be imposed only if you are able to show how that has harmed either US competitiveness or
Right.
how it has harmed in industry, right?
Hmm.
You can't just simply say because of geopolitical expediency, I'm imposing a tariff, which is what they've done using
Right.
IEPA, right?
Sure. Yeah.
So that goes away.
Okay.
But just because that goes away, that doesn't mean that there is any real relief because the US will come back on US, on India, now using 232 and using Section 301.
Okay.
As I said, Section 301 and 232 are cumbersome.
Right.
They take a long time to put in place, but they can be put in place.
Okay.
And if you look at the tariffs used under 301, which was the China 2018 tariffs, they didn't go away under Biden. In fact, under Biden administration, they were intensified, increased. So Indian exporters might get a brief relief while the US Department of Justice and US State Representative Office is trying to put together the 301 tariffs in India. But those tariffs are going to be back on India. They may not be a blanket 50%, but they might be 75% on something, 25% on something, 10% on something. But I do not think that the overall tariff may not be 50%, but I don't see them going back to what it used to be before all of this had happened. So yes, there is a relief. You can breathe a little easy for about a few months, but the tariffs are going to be back. And the reason why the tariffs are back is because let's look at what India has itself done over the last 10, 15 years. India itself has gone and increased trade barriers and tariffs.
Yeah.
And it is not just that I'm saying this. The previous chief economic advisor, while he was in the office, talked about it. Arvind, the current chief economic advisor, as he's in the office, has talked about it.
Right.
You simply can't keep on increasing trade barriers and expect nobody else to react to it. India has increased trade barriers.
That's
the import tariffs of India's import tariff regime today is significantly higher than the import tariff regime was about 15 years back. So if you do that, then countries will react.
So there's a greater degree of protectionism that you see in India, and that's what's playing out against us at the moment when it comes to trade agreements and trade deals.
Sorry, I lost you for a second. Can you hear me?
I'm saying, so there is a heightened sense of protectionism that you sense in India at the moment, which is
it has been going on for the last 10 years. Because it was protectionism by us, we didn't care about it. Because it protected our domestic industry, we didn't really care about it. But there is always a price to be paid. I will give you a much simpler example, which doesn't have to do anything with the protectionism. We have protected the Indian vineyards, wine industry for the last 50, 60 years.
Right.
By imposing massive tariffs on imported wine. I'm not talking about liquor, I'm just talking about wine.
Yeah.
What has it got India? That interesting. We do not even have, after 60 years of protection, we don't even have a wine industry that can match the Argentinas and the South Africas of the world. Forget about the Australias and the New Zealands of the world. What is the point of that protection?
And
if the wine industry in India doesn't survive with that protection after 60 years. So my point is that India simply cannot go and point a finger to the US and say, well, you are imposing tariffs on me, and that is unfair. India could have easily brought down those tariffs and said, look, guys, 60 years have gone by. We'll stop the protection. We haven't done that.
Fair enough. So, you have described a significant shift in the US foreign policy back to the Monroe Doctrine and spheres of influence. So, according to you, how should India reposition itself as a strategic partner? If the United States also continues to retreat from internationalism to regional protectionism.
So this makes probably India's, extant foreign policy, which I'm not an expert on, so I'm going to give you my layman's view, which is that, look, we want to balance everything else. We want to balance the US on one side, China on the other side, Russia on the other side, the European Union on the other side. But we also want to keep our regional influence intact.
Yeah.
So it isn't that India did not have a Monroe Doctrine. We call it a Monroe Doctrine. I think we call it the Gujarat Doctrine, if I remember correctly. Okay?
Right.
Well, we also did the same thing. As long as our region, our subcontinent, was within our influence, we were happy. Right. So if the US shifts towards regionalism, which is, look, Western Hemisphere is our backyard, don't touch Western. In the other places, the big superpowers, regional superpowers can do not whatever they feel like doing, but do things in their own sort of limits. We'll be okay with it. Which is why they're sort of exiting out of Europe. They've exited out of Asia, which allows both Russia, China, both of them much greater freedom if all of this passes. I don't know whether it is going to happen or not. If all of this passes, much greater freedom to impose and exert significantly more regional influence than they had been allowed to do otherwise. So in that world, India will have to rethink its objectives, rethink its position. It is no longer the case that, as we have seen, no longer the case, something goes wrong because India is a buffer against China, therefore US will treat India differently than any other country. That hasn't worked. That was, it may not have been overtly said by the government, but if you spoke with the government or you spoke with the people in the market, there was a complete sense of complacency. The US is not going to do anything with India because US needs India against China. What happened to that? What happened to that?
Right.
Today, India has the largest tariffs.
Yes.
Even more than China has.
Yeah. What do you think happened there, Mr. Aziz? Where have we gone wrong
Look, I have no idea what kind, and on the world of diplomacy, etc. As I said, why India suddenly went to the bad books of US, etc. I mean, I don't have any deep insight into it. But from an economic standpoint, as I've said, you simply cannot keep on raising trade barriers and not expect your trade partners to react. Just because your trade partners have not reacted in the past, that does not mean they won't do it. Sooner or later, your trading partners will react, and they reacted. Now, I'm not saying that justifies a 50% tariff or whatever it is. I'm not saying that. But if you raise protectionism, then you need to be prepared to pay for reciprocal protectionism sooner or later.
Fair enough. We have the budget barely 2 weeks away now. In your view, Mr. Aziz, what are the absolute imperatives that the Modi government must address in this budget? We've seen a slew of reforms in the run up to the budget. We've seen GST reforms, we've seen a lot of focus on ease of doing business, income tax reforms. Private sector continues to be, wary of investing for whatever reasons. So, what, according to you, are the most important things that the budget needs to address to really get the momentum going?
So I've stopped advising governments as to what they should be doing, okay? Because it doesn't really work, right? All of us are talking from where we sit and from our position.
Fair enough.
My own sense of what the budget will do is that they will meet the 4.4% deficit target this year.
Okay.
May not be very cleanly because there's a significant decline in tax revenues because of the nominal GDP going down very, very sharply, and because of the rates coming down on GST. But I think they'll make it up for slower spending and getting revenue from the usual sources, RBIs and public sector undertakings. And the next year, they're going to target a budget deficit which is lower than 4.4.
Okay.
Not because there is any deep economic imperative that that's what they should do. The deep economic imperative will be the same old thing, which is, well, we want to reduce the imprint of the government in capital markets so that the private sector can have more breathing space. But in reality, this government likes to see, is a very conservative, fiscally conservative government, to be very, very fair. And they're going to target, and they think that targeting a lower fiscal deficit is a big tick mark on their achievements, and they'll do that. So we are looking at about 4.2%.
Okay.
With a 4.2% deficit target, with a nominal GDP of only 8%, or let's say lower,
yeah,
we don't have very much space to do anything. So what space can you create? Not very much. The space that can be created is outside the hands of, I mean, it's not outside the hands of the finance ministry, but it's outside the purview of the budget per se. It is in capital market reforms.
Okay.
That is where the finance ministry needs to focus on.
Okay.
And I haven't seen any major capital market reform in the last, I have no idea, 10, 15 years.
So capital market reforms to enable more retail investor participation, or what should they be targeted towards?
Let's look at the problem. So India's GDP has at least doubled, probably more than doubled over the last 15 years.
Right.
In this doubling, look at the top 10 listed companies in any sector. Apart from telecom, where there has not been a single new entrant in the leadership, in industry leadership. How is that possible? The only way it is possible if in India there is the capital markets allow even greater concentration, capital, and they allow even more entrenchment of the incumbency. There are at least few 100,000, I'm exaggerating, but let's say few 100,000 probably is the right number of startups.
Yeah.
Why haven't these startups become where is one startup in the top 10 ranking in any industry? Take any industry. Give me a startup that has made it to the top 10. Not one. Right. Including the payments and the delivery startups. Right. They are not number ones in logistics. In the top 10 of the logistics. So there is a problem that while there is massive amount of entrepreneurial interest in India, where everyone is going around trying to look for the new breakthrough, albeit almost entirely concentrated in services and almost nothing in manufacturing. I mean, there's a smattering of electric vehicles, whether you're motorbikes or cars, and probably some in defense technology, which are manufacturing, quote unquote. The rest of them are all in services, and there's a reason for that. That's a separate issue. But what happens to them? I mean, startups are not something that happened only 2 years ago. Most of these startups are from the last 10 years we've been hearing about startups. If in 10 years' time a startup does not make it into the top 10 in any sector, you need to ask the question, what is going on over here? And I think one of the reasons is the capital market. In India, you can get VC money, you can get private equity market to start startup.
Yeah.
You have public money, retail money, institutional money to take that startup and do an IPO. What about the money in between?
Yeah.
You will require money for the 3-year, 5-year period to expand the startup to a point where the IPOs are not $100 billion, $10 billion, but $100 billion.
Yeah. Fair enough.
And that is where the capital market reforms come into play.
Okay.
Where is the 3-5-year money available to uncollateralized money available to startups?
Fair enough. We're running out of time, Mr. Aziz. Very quickly, I want to ask you about, the regaining, reviving FDI and FPI investment flows in India, because we've seen an exodus of sorts in the last few months. Actually, how do we get FIIs and FPIs to come back into the country? And how are you reading into this? Do you think it's a cause of concern?
Right. So there are two parts to the question. One is FDI, the other is FPI. So let's separate the two of them. On FDI, look at gross inflows. Gross inflows haven't really dropped off. Gross inflows have slowed down, but they haven't been as dramatic as net FDI inflows have been. And large part of that is because all of these IPOs that we are seeing, and we are jubilant about the fact that we are having all of these massive IPOs.
Yeah.
Most of those IPOs were actually funded by foreign private capital and foreign private equity.
Right.
And they're taking the money out. So the question that needs to be asked is, why aren't they reinvesting in that money in India?
Is it because they don't...
that have successfully IPO'd, that money has been taken out. It's not being reinvested.
Yeah. Yeah.
We have what, 7-8% growth rate. There is not a single economy in the world with that kind of official growth rate. Let me rephrase it. Official 7-8% growth rate. Not one country. So how come they're not going there? So that's my thing. So FDI, it isn't so much that, gross FDI is coming down. The foreigners are not, or the MNCs are not bringing money in. It is that those who have been in India for the last 10 years, now that they are able to monetize their investments, are not coming back, are not reinvesting. It's a completely different problem. The second part is about FPI.
Yeah.
Right? So India's main market is the equity market. It's not the fixed income market.
Right.
As I said, look around India's equity market. Give me a company that is valued, let's say, at $5 billion, $10 billion today, but has the potential of becoming a $500 billion company in the next 10 years. Name me a company. One company. We don't have any. So if you don't have any such companies, people do not invest in India. Only hedge funds and fast money invest in India by, buying, the index. Okay.
Okay.
People invest in companies.
Sure.
Give me a company that is valued at $5-10 billion, that has potential going $500 billion, money will come in. Right now, there are no companies. You either have very, very matured companies for the last 40, 50 years, whose potential going up is very limited. You bring in $1 billion a week in India, the Indian stock market gets overvalued. The moment it is overvalued, the trade is killed. You cannot have a market that gets overvalued by $5 billion of money coming in. Because then what is the trade? There's no more trade left. I need to have a market in which I bring in $5 billion, but there is another potential valuation gain of $100 billion. Then I'll bring the money in. But this is not just the case of India. In the emerging market world, if you take out China, there isn't any emerging market world, any country that has any company of this kind. And there's a reason as to why this idea that people are junking US assets and moving elsewhere, that's not true. It hasn't happened. And even if it does happen, it'll take a very long time. Look at Korea. There's one company, well, two companies, Samsung and Hynix.
Yeah.
Look at Taiwan. It's TSMC. Brazil has only commodity companies. So I might as well play commodity. Why should I go for the companies? So does South Africa. Only commodity companies. India is only one that had Mexico. Most of Mexico's companies are family owned, so they're not listed. They're not public assets. In India, it is. They're public assets. Whatever, 5,000, 6,000 listed companies. The problem is that either the small companies have very small, very low potential, or we have very mature companies. We don't have the middle, which is why I said you need capital market reforms.
All right. Thank you so much, Mr. Aziz. I think we've run out of time, but thank you for that, dose of reality. And that's what one expects from you, a very, very candid analysis of where we are and what India's challenges are. We'll, of course, we would love to have another conversation with you post the budget to get a sense of what you think of the roadmap that will be presented on the 1st of February. Thank you so much for joining us. And yes, we'll come back to you with a far greater analysis of the budget. Thank you, Mr. Aziz.
Thank you very much. Bye.